Well, hi, I'm Carrie Millar of Dentist Insurance Services, and I am a commercial insurance broker. I've actually been in insurance for 21 years. I have my undergrad in risk management insurance and my MBA, and I've been at Dentist Insurance Services the whole time. So, all I've ever done is help dentists and dental practices and dental practice owners and DSOs and DPOs ensure their office and their building and their practices and their employees, and that's what we do. And so this is liability loopholes and how to ensure your dental group is fully covered. So, like I said, I'm Carrie Millar. I am based out of Tallahassee, Florida, but I am licensed in, I think, 28 states now. And I have a team of 25 over at Dentist Insurance Services, and we have been in business since 1989. And all we do is dental risk. And so we are here to help dentists, dental practice owners, and group dental practices. And we started out in just Florida because that's where we're located. And through I think the last 12, 15 years, we have gone national and are now in almost every single state and can write in every state as we have practices grow into those states. So our whole purpose is to help our clients succeed. And we are all about transparency and making sure you have the best coverage and you understand what you have and what you're getting. So we're going to go ahead and dive into this. Today, we're going to talk about malpractice insurance, cyber liability insurance, office insurance, and business management insurance. Now, our office also does employee benefits and self-funded plans, but these are the basic four commercial risks that we see when it comes to group practices and where there are some mistakes made, and where people need to make sure they understand what claims we're seeing, what emerging threats we're seeing. We have over 10,000 clients nationwide. And so we do see claims on a weekly basis and we see patterns and we see what's happening. So we just want to make sure everybody's aware of what needs to happen. Before we get started, please feel free to put questions in the chat and I will get to them at the end, or you can email me or text me after this if you have personal questions you want to ask for advice on. So we're going to talk a little bit about corporate structure today and the different types of policies, and everybody's a little bit different. So when we talk about 100% common ownership, that can be multiple practices, but there is 100% common ownership. So we're going to call that the 100. So in that situation, it's either one dentist or partner dentist or a multiple partners all have the same ownership structure. And so in most states, this needs to be a dentist, but not in all states. So there are some states where you don't have to be a dentist to be a dental practice owner, and then you can 100% have the 100 common ownership. The second form of structure we see is the 51%. That's where there is a majority owner of the policy. In some states, again, it has to be a dentist. Sometimes it doesn't. So as long as there is 51% or more common ownership, we're going to call those the 51. And then obviously there are lots of other ways to structure companies besides having 100% ownership or at least 51%. And a lot of those involve professional service agreements. So we're going to call those the PSA. So as we go through these different policy types and where your liability is, your corporate structure is really important, just of how you're staffed, so that we understand that even though the supporting entity does not own 50% of the ownership, they might have a professional service agreement that gives them insurable interest. And we're going to review how to do those. So we're going to go over malpractice insurance because it's something that everybody has to have in this business, and not everybody understands, or everybody has a different approach on how things should be done and how we should stack them. Looking at claims wise, we have not seen an increase in frequency. So the number of claims we see filed from year to year has not drastically increased. It's remained pretty flat and even. But what has dramatically increased is the severity of the verdicts. So we're not seeing as many claims. We're actually seeing about the same number of claims, but the claims we're seeing are much, much larger. And so because of this, um, I mean, it's just very outstanding how many we're seeing. So what we feel is contributing to this is social inflation, which is juries feeling that larger verdicts, or what we would call nuclear verdicts over 10 million in the dental space, are becoming more common practice, and that it is okay for them to give those verdicts because the plaintiff can afford it, or the defendant can afford it, things like that. We're also seeing a lot of third-party litigation financing. So we are seeing private equity and venture capital go into law firms and support those lawsuits in order to get a percentage of the awards if the case is won. So we're definitely seeing third-party litigation is another reason why the severity is going up. And the final thing that we're seeing is that depending on the state, we're seeing a lot of attacks on tort reforms. Colorado just last year increased their liability caps. California had to increase theirs not too long ago. A lot of people are starting to put inflation guards on them. So where we used to think, oh, this state, there's an inflation guard, or sorry, there's a cap on litigation, and so we know what the maximum amount's going to be. We're starting to see those tort reforms go away. So people are always like, oh, it's in medical malpractice. That's not dentist. It's not the same thing. Dental is not as litigious, or there's not as high a verdicts. And that's just not what we're seeing now. In 2023, we had a $14.8 million verdict for an oral surgeon in Washington. In Georgia in 2023, it was actually the beginning of 2024, there was a $10 million verdict for a general dentist in Georgia. And I'm not to say this to be mean, but there was in the Georgia dental situation, there was not a loss of life. It was just a root canal and a loss of sensitivity in the jaw and mouth area, and that still led to a $10 million verdict, which is just very nuclear for that type of situation, and typically would have normally resulted in 100 to 250,000 verdict is what we typically see in that space and in that profession. And so as you can see, the severity is increasing drastically. When we talk about malpractice insurance, we're going to talk a little bit about different types, and we're going to talk about how to structure it, but I want to make sure we're on board with all the same terminology. So the first named insured is the person who controls the policy. They have the right to cancel the policy, change the policy, renew the policy. It does not matter who pays for the policy or who sends the premium in. The first named insured is in charge of the policy and has the most rights. When we talk about additional named insured, this is another person who has interest, but not as much control. So they may be protected under the policy, but they probably don't have the right to cancel it or change it, or to consent to settle, or get any type of refunds on the policy if they are not the first named insured. It doesn't mean you don't have a separate arrangement between the first named insured and an additional named insured on the back end. But as the insurance policy goes, the first named insured is the one that has the most power. And when we talk about consent to settles and what that means, a true consent to settle is the ability for the first named insured to say, yes, I want to settle this lawsuit, or no, I do not want to settle this lawsuit, and for the insurance company to defend that policyholder, that first named insured, up into the policy limits if they choose not to settle. So there are some policies that will say, oh, we have a consent to settle, but it has a hammer clause in it, which means that if they refuse a reasonable settlement, then the the insured is on the hook for any higher legal costs or damages above that reasonable settlement. So you just want to make sure you don't have a hammer clause, and really have a true consent to settle when allowed. When we talk about vicarious liability, what this is you have an insurance policy, and it covers you, and it lists the people in the policy who are covered. However, sometimes you have either supervising dentists or subcontractors or other people come in, and what the vicarious liability does, it gives protection for you for work that they perform if their policy limits are already exhausted. So if you thought that, this contractor who came in had their own coverage, turns out that they didn't pay their premium or something happened, there would be coverage for you and defense costs for you for work that they did because you have them listed on your policy as vicarious, but there is no coverage for them. It does not extend to them. It's just protecting you. And then we're going to talk about individual limits and shared limits, and basically the different bags of money. So when we talk about individual limits, that means each person has their own separate bag of money that are there for limits. And then a lot of times there is either entity coverage or corporation coverage that can either share in those same bags or also has their own bag of money. So when you look at limits, you want to see if they're separate or shared and if they're scheduled. And so you just kind of want to get a good idea of what you're paying for and how many different bags of money you can tap into in case of a lawsuit. Now, in our industry, malpractice insurance has two different options. You have a claims made or an occurrence policy. A claims made policy is similar to a subscription, like a Netflix subscription. You have coverage in place while you have the subscription. If you stop practicing dentistry and decide to turn off your subscription, then you no longer have coverage. And if somebody were to bring a suit in the future from when you were working, you would not have coverage. So in that case, you have to purchase what they call a tail coverage. The tail coverage, similar to the Netflix, does not provide you future coverage for new patients, but what it does is it provides runoff. So any patients that you saw while you had the policy in place, but bring suit in the future when the claim is made, will be covered if you purchase the tail, or what they call an extended reporting endorsement. Now, these policies are very, very common for dentists that have been practicing for a long time. So it wasn't until about 12, 13 years ago that we started to see the second type of insurance, which is a occurrence policy, come around and become more prevalent. Unlike claims made policies, they do not require a tail. However, they are typically 30 to 50% more in cost than a claims made policy. And when you go from a claims made policy to an occurrence policy, you have to tail out that claims made policy. You can't just convert it into an occurrence. And so it is usually pretty counterintuitive cost wise, or counter prohibitive, to switch from a claims made to an occurrence. Now, there is nothing wrong with a claims made policy as long as you keep it in force, or you purchase the tail upon retirement, or most malpractice carriers will give you tail upon retirement. So as long as you understand that you have to buy a tail, you keep the policy in force, there is no reason why you would need to switch to an occurrence. We do typically tell younger dentists who are coming out of school, who are starting at their first practice, who might not be at their forever practice, to purchase an occurrence policy if possible. But you want to make sure, if you're in a group situation and you're looking to attract younger, newer dentists, or you're looking to purchase existing dental practices, that you understand what your office has, whether it's a claims made or an occurrence or a combination of both. I write a lot of those where we have both policy forms available, so that when you're under LOI on an existing office that you're thinking about selling, okay, they have a claims made. I can either require them to tail it out and come onto my occurrence, or we can pre-negotiate that, or I can pick up their prior acts, which is the nose coverage. If I only have a claims made, or if they have an occurrence, they're going to have to start over on a claims made. So you want to go ahead and make sure you put those into the LOI and you understand what you're getting when you going forward, just because it can be pretty sticker shock if you haven't talked to that beforehand and all of a sudden you have to buy all these tails to get them onto your occurrence, or they weren't aware, and it makes sense that you get that all up front. So yeah, a helpful tip is if you are a group practice that has multiple locations and you're looking to bring on or purchase out existing dental offices, or you have mature dentists that are coming to work for you and they're coming to you with claims made policies, and then you have a separate group of younger new associates. We typically will write two policies: a claims made policy for the long-term dentist and an occurrence policy for the new dentists that are joining the practice. And eventually it will write itself to being pretty much all occurrence. But as the existing ones come on and you pick up their retro date, then as they retire, they come off the policy with their free tail. And as the younger ones come on, they come on as an occurrence. So then as that associate leaves, you don't have to worry about trying to track them down and get them to pay for the tail, or have somebody in credentialing figure out, did they pay for the tail, or did they get a claims made policy that has full retro? And it's a lot of paperwork. So we do write a lot of those combo policies. So here's a fun claim scenario, and we often go over this, and this is going to kind of help to discuss how we decide to stack these policies. So you have, we're going to call the dental practice Smile Store, and Smile Store has a few different locations, and they have several different dentists. And they had a dentist, we're going to call them Bob, dentist one. He took an x-ray, recommended a root canal, which was completed. And then a few months later, the same patient comes back with pain, and dentist one is not there. They're unavailable, or they're on vacation, or they're in a different location. And dentist two sees the patient. So now you have two people seeing one patient, and they recommending redoing the root canal, but that patient didn't do it. They went back to dentist one. The pain didn't go away. They ended up in the hospital, in the emergency room for swelling and fever, and the doctors there diagnosed them with a serious infection, right? And after the surgery, the patient decided to bring suit. So whose insurance would cover this? Is it dentist one? Is it dentist two? Where are we at? So this is why we have to talk about structure. In those situations, it's very, very hard to figure out who would be to blame and who wouldn't not be named. So we have three possible people that can be listed. We have the corporate entity, the Smile Store, who's gonna be named on the suit because that's the name on the building that patient went to. We have the first dentist that saw them, dentist one, and that's, we're gonna call them Doug, dentist Doug. He's the employee dentist that saw them the first time. And then we have a 1099 employee, and we're going to call him Bob, and he's dentist two. So in this situation, if we let every dentist just carry their own policy and the corporate has no separate coverage, who has coverage in place? Well, in this situation, the corporate entity does not have coverage because there's not a separate coverage in place. Doug has a policy for him, and Bob has a policy for himself. So they both have defense and policy limits. Now, is there a chance that Doug's insurance carrier, if different than Bob's, is going to say, nope, it wasn't us, it was Bob, and Bob's is going to say, nope, it was Doug? There is. So if you're going to get this structure, we would recommend that at least Doug and Bob have the same carrier, so that either way the carrier is going to be on the hook, and so that way they don't argue about which dentist is at fault, but go ahead and defend the claim. So in some situations, the dentists carry their own policy and the corporate asks to be named on their policy as additional insured. We see this very commonly. And once a year, they ask for a certificate that shows that they have coverage for the entity. And this works okay sometimes because Doug still has a policy and Bob still has a policy, but the corporate entity just hopes that Doug and Bob keep their policies active and hopes that they keep them named on there and hopes that it worked out correctly, but doesn't control them themselves. So in this situation, the corporate structure is still very vulnerable to situations, but Doug and Bob still have their own policies. Now, there is a way, or a very common way, is that the dentists will each carry their own policy and the corporate will have their own separate coverage for vicarious liability. So in that situation, the corporate entity has a bag of money, each dentist has their own bag of money, and everybody has coverage, and that's great. So you have an entity policy, an individual policy, and an individual policy. Now, is this sustainable? Does this make sense? Is this a good structure? This is a great structure if there's only a few people. But once you get to group practice size where it's not manageable, or you're not taking into account the scalability, then you have another situation. So you have a compliance department. It might be your front desk person. It might be a whole separate department. It might be one person. You might be, depending on your size. But they need to get certificates of insurance for each Doug and Bob every year at their renewal. And if Doug and Bob each have their own policy and it renews at a different time of year, then it's constant with credentialing. It's constantly having to keep up on top of it. And we're also assuming that Doug and Bob kept their policies in place. Also, you come to a point where there's savings. If you have more dentists together in a practice, you can then negotiate with the different malpractice carriers for additional discounts, especially if you have great risk management and loss claim history. You can go and say, look, we have a great practice. We are very methodical in how we practice dentistry. And because of that, we have had no claims in 5 years. There's 50 of us. We would like to have an additional 20% discount. Or there's 15 of us. We'd like an extra 10%. Right? So you want to make sure you're taking advantage of the scalability savings. And the last part that we don't always think about is the consent to settle. So in this situation, each person has their own consent to settle. So Bob can settle, Doug can settle, and so can the corporate entity. And they can't settle on each other's behalf. Well, if you're in a group practice situation, and let's say there's like a $50,000 claim, and you think it would make sense to go ahead and settle as a cost of doing business, you might get a Bob the dentist who says, no, I didn't do this. I don't want to settle, and I want to fight to my policy limits. And that's their right under that policy. But now you might end up being part of that lawsuit and have to go along with it because of the consent to settle wasn't there. So there's another policy structure, and we really like this one. And this is where the group carries the malpractice coverage with separate limits for each employee dentist. And then they all share in the limits for the corporate entity. So in this situation, there is one policy. Each dentist has a bag of money. There's vicarious for any contractors who are not employee dentists. And the corporate entity shares in the limits. So they don't have their own set of money, but they control the group policy and they share in those limits for each of the dentists. And so in that situation, everybody is covered. There is compliance, there's scalability savings, and the consent to settle stays with the group who is typically the person either paying for the coverage or the person who's getting the bill, who then passes the cost down to the associate dentist, depending on the employment arrangement. So when we talk about policy structure and how many policies you need, when it comes to group malpractice coverage, if it's 100% ownership, then one policy is perfectly fine for group coverage, because they can all share in the limits or have separate entity limits, and you don't need one policy for each friendly PC. If you have multiple owners, but they at least have common ownership, then you can have one policy in the main entity name and list all the extra entities' names that are owned by the owners, as long as there's a 51% ownership. And then if you have an arrangement where it's a professional service agreement, then unless your carrier is okay with naming multiple entities that don't have common ownership, you're going to want to get one policy for every friendly PC. So if you have it set up where each state is a different friendly PC, or maybe 4 or 5 offices fall under one entity, then you're going to want to have one for each of those entities, unless you have a malpractice carrier that's willing to list all of them. So that's all I have on malpractice, and I'm going to go ahead and move on to cyber liability, which is just a huge risk we are facing right now. I was just in New York at a cyber conference 2 weeks ago, and it's just really alarming to see the amount of attacks that are happening and the amount of ransom people are asking for, and the amount of business email compromises we're seeing. And they're just getting more and more clever and trickier, and it's really scary out there. The FBI recommends that dental offices take a 3-pronged approach to cybersecurity. So you want to have great cyber IT security, really strong IT. You want to have a HIPAA compliant procedures, whether you keep it in-house or you use Abide or a compliance company. And then you want to have a strong cyber liability insurance policy in case something happens. So the first two, the IT and the HIPAA, are meant for prevention, and then the cyber insurance policy is there in case something happens. So why dental offices? Well, there's several reasons. One is there's budgetary constraints. We don't have as much money to spend on IT and to keep, fortifying things and patching and buying all new systems constantly. If I could tell you how many people haven't updated to Windows 11, which is going to become a huge security risk in October of this year, we tend to make investments in IT at the beginning of our practices, and they tend to be ownership investments and not leasing situations. And so we don't want to replace those computers, and we don't want to replace that system until we really have to. And so because of that, it leaves us susceptible to patching issues and other ways to get in. The other thing is that we have really valuable information. Patient health information is not just credit cards and social security numbers. It's credit cards, social security numbers, addresses, date of births, sometimes medical health insurance information and dental insurance information. So they are opening up bank accounts. They are opening up loans. They are making false dental claims. They are using that information for multiple other things. So the amount of people affected is just really high, and that's why they're coming after, because dental is a low-hanging fruit for them. An example of a claim that we have seen recently is we had an office that had 10 locations, and their front desk receptionist got a call from the patient saying, "Oh, hey, I tried to fill out your enrollment forms online and I couldn't do it. So could you go ahead and email me a copy of the medical questionnaire and, excuse me. Can you email me a copy of the medical questionnaire and I'll fill it out?" And then they hung up. She emailed them the medical questionnaire. They emailed it back. They called her and said, "Hey, did you get it? oh, by the way, my x-rays are on there. Can you click that link? And as soon as they clicked it, they were in. In this situation, they were in. She didn't think anything of it. Obviously, it didn't all of a sudden go ding, 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 and you're hacked. But 3 weeks later, which happened to be Martin Luther King weekend, so sometime over that weekend, um, they they went in on that Tuesday morning. They were locked down. One of their devices had a ransom request for $500,000, and they were locked out of their systems. And it's a Tuesday morning. You have people in the office. Patients are starting to come in. You don't know what's going on. The answer is not to unplug all your computers and restart, right? You have to do an forensic investigation cost under HIPAA. You have to notify all the patients if they were able to go all the way into the patient data. And without a forensic investigation, you won't know who and was not affected. In most situations, they're having to replace all the computers, the hardware, the software, and the backups, especially in server situations. We're seeing them get into the backups. So you can't rely on going back a week or 2 weeks. And it gets really, really expensive. And it used to be that we just had the first party claims, and I'm going to go ahead and change slides. And so you had the loss of income, you had the cyber ransom, you had the funds transfer costs, you had the notification and the forensic investigation. But now we're also starting to see the liability. So patients are starting to sue in class action lawsuits because their patient health information was compromised. And so every time you notify a patient, that is a potential lawsuit in the future. So you can look, Great Expressions just settled for, I think, 2.4 million from a data breach that happened in 2022. So, if you just search data breach or class action, you'll see that there's tons of legal offices out there soliciting for patients who have been attacked by this or this one. Sometimes it might be a patient of yours that has a law firm that received the patient expense, the notification, and are trying to find other patients. So it's kind of scary out there how quickly it happens. People ask me all the time, how much is enough? And that's really hard to tell. But as a general rule of thumb, what I tell people is to get at least double what your monthly revenues are. So that way you have enough money for the business income, because you're probably going to be closed for at least 2 or 3 weeks. And then sometimes if you have multiple offices and you guys are all using the same EHR, it's going to be multiple offices closed. And so that's revenue that you just can't get back. And so it's a time element thing. So you want to make sure you have enough money for your business income. And then you want to make sure that you have enough money for the ransom, the funds transfer, and the liability if it ever comes to it. So how many cyber policies do you need? Well, if you are 100% owned by one entity, one cyber policy is fine. And that's fine if you have 20 websites. You just want to make sure that you consider all of the different offices' revenues in that one policy. If you have the 51% majority, most of the time you could get one policy and add all the named insureds in place. And again, all the websites can be used. But if you have a professional service agreement, there's a situation in place where there is a chance that if you have multiple policies, one for each of the friendly PCs, you might have an issue with stacking, because you can't stack coverages. You can't say, oh, I have 100,000 in cyber here and 100,000 here, so I have 200,000 total. That's not how most cyber policies work. So you need to make sure in that situation that you probably carry a policy, either one policy, and we list all the friendly PCs and we ask them to do that to basically endorse it onto the policy and use friendly terminology and wording. Or you get one policy for each friendly PC and you ask them to take off the non-stack stacking clause, so that there's no chance that you wouldn't be able to get each set of limits, because you don't want to have $1 million for each friendly PC, which is 10 million in coverage, and then have one practice have a claim and then another state be affected and only have a million between the two states, that's just diluting your limit. So you just want to make sure you're really, really careful about that stacking exclusion. Office insurance. So office insurance is usually a big part of the dental offices. Fire, theft, slip and falls, anything like that that comes up. The cost for it varies drastically across the country, especially where you are in natural disaster situations. And we're going to talk a little bit about the different stuff you should have in your policy. You should definitely have business income. This is going to replace any type of revenues while the office is down because of physical damage. So there does have to be physical damage to the building or the practice in order to trigger a business income claim. And then it will pay. And typically they'll look at either what you had on the books as far as schedule or what you did in the last 3 months, or they'll look at 3 years historically. So when this happens and you file a business income claim, we really strongly recommend that you do all that forensic accounting yourself beforehand and say, this is how much I'm out in business income. Like, this is what I want, because not every adjuster understands how dental offices work and that dental is a time sensitive situation. And they're like, oh, well, you can just see all those patients next week. And you're like, I can, but those are all chairs that can't be filled by new patients. So eventually it catches up. So go ahead and look at what you do historically, or if you know what you typically do in a week, or you know what you do that time of year, especially if you if you're a pediatric and so like you're busier in the summer or you're busier in December, December and January when the kids are out, you want to make sure you take that into account. A typical policy will cover the property, whether it's the building itself or just the dental equipment and the office insurance. And you want to ensure that at a replacement cost value. So what that means is they're not going to say, oh, this chair is 10 years old, so we'll pay you for what, a 10-year-old chair is. You want them to pay to replace that chair with a new chair. So they are going to do replacement cost value if you can get it, is the best way to do it. And you also want to make sure you check your lease, because there are some situations where you don't own the building, but that you might be responsible for ensuring the improvements and betterments of the tenant. So if you came in and built out your space, your lease might require you to ensure those tenants' improvements and betterments, and that can really eat at your limits. Especially if you aren't aware that you are going to be responsible. So in an event of let's say the building burnt down, the landlord might rebuild the structure, but they're not going to build out the cabinets and the flooring and all that again. And if you haven't taken that into consideration in your insurance coverage, you would be out of luck. So you want to make sure you check that lease for tenants improvements and betterment. Most policies have general liability. That's a slip and fall. We don't see a lot of claims in the dental world on that, because most of the liability that happens in an office is professional. As soon as the patient their butt is in the chair, it becomes professional liability. So I've had situations where a lamp has broken while they were sitting in the chair and they got cut by glass. That's professional liability. I've had a situation where they've slipped and fallen in the parking lot on the way out to their car. It's professional liability. So for the most part, you're not going to see as much general liability. When you do, it's either when they first come in, or the people that are coming with them to take them to the dentist. So if their chaperone or whoever falls in the parking lot, that kind of stuff. Equipment breakdown coverage is great. It helps with mechanical and electrical issues. And you want to if you have a big policy for property, you want to make sure that you look and see if you have a co-insurance clause. It's something that not a lot of agents talk about, but if you are underinsured and you have a co-insurance clause, it can hurt you in a partial loss. So if you have $1 million worth of coverage, but you should have 1.5 million. They're going to go and so therefore you're not insured to value and you have a 100% insurance clause, then they're going to penalize you 20% from any partial loss because you were not insured to value. And the same thing with the 90% and the 80, it's just they're not going to penalize you as much. So you just want to make sure if you have a co-insurance clause, you understand that and that you really have a good idea on what the replacement cost value of your equipment is, especially since the cost to build new or to equip new offices has really drastically gone up in the last 2 or 3 years. And finally, you can have actual value clause. So this is more common in flood. It's definitely common in offices. If you're in a location and you know that if something happens to your building, you're not going to build it back, or you're going to get out of dentistry, or I have some people that are in like coastal areas and they're like, yeah, if we get hit by a hurricane or a flood, we're just going to go move inland and we're just going to sell this property. Then you can insure to actual value, and it's not replacement costs, and they'll just give you the actual value, which is the depreciation. But then you do not have to rebuild. You can just take that money. So it does take into account depreciation, but it really is a way to save money on an office insurance policy if you're not planning on rebuilding. Now, an idea that I really like and is really good for offices that have multiple locations, especially if your multiple locations are in a very spread, are very spread, whether regionally or nationally. It helps you lower the cost of insurance because you take that risk and you spread it around. So we're going to talk about how that works. So typically, if you have multiple offices, in this case, they have 3, you have a set of limits for each of your practices for the business personal property. So in this situation, we have 3 practices. Each of them have 450,000 in coverage. So they have a total of, what is that? 1.3 million. That's really bad math. So in that situation, if they were to have a claim of 450,000 at practice 1 and 500,000 on practice 2, and no claim on practice 3, they would have a total loss of 650,000, but they would not have all 650,000 pay out because practice 2 only has 450,000 in limits. So 1 is going to be paid at 150, 2 is only going to be paid at 450, and so therefore, even though they have all this insurance, they would only get paid out 600,000. But if you switch this from a schedule to a blanket, and everybody shares in that 1.35 million, then in this situation, if those same losses occur, where location 1 has the 150 and location 2 has the 500, the policy is going to pay out 650,000 because it's one lump sum of money that all of those practices can use. And so what we do with that is we say, okay, let's see, we have this many number of practices, right? And these practices are in this geographic area. What is the risk, right? And with that area, what is the hurricane risk, the flood risk, the fire risk, right? What is the co-insurance clause? Do we own the buildings? Do we just own contents? And when it comes to that, then do we need that full amount of insurance? Do we need to have 450,000 for each practice, or can we reduce that using an actuarial calculator to say, you know what, because there's 10 practices and they are all within, they're all more than 30 miles from each other or whatever it may be, and they're only contents, like maybe we can go ahead and reduce our total exposure by 20%, or maybe we can even by only 75% because we're able to move those limits around because it's a blanket. So it's a great way to save money and also spread out your risk. When it comes to package policies, the sole ownership, right? One entity is the named owner, 100% ownership. they only need one policy. They're super combinable, even if they own the practice in one name and they own a building in a different name and the real estate in multiple different names. That's perfectly fine. You can add them all on as named insureds. They're very combinable. The 51%, you should be able to get them all combined. They should be able to name them. The only time I would see those separated out is if any of the landlords have different clauses about it, or in situations where you have so many practice locations, it would make sense to reduce the amount of risk or spread the risk differently. Instead of having one giant umbrella blanket, you have multiple blankets to try and reduce the costs. And then for the professional service agreements, if you can find a carrier that acknowledges that a professional service agreement gives insurable interest, then you can have a policy in the name of the service organization, and then each of the entities can be listed on as named insured. But not all carriers are willing to do this. Not all of them understand the way that multi-group practices work as far as with professional service agreements and DSOs and DBOs and MSOs. So if that happens and they're not willing to look at it, then you would want to write one in each of the friendly PC's names with like terms. So you would have multiple policies, but you would keep them still as many locations that are owned by one of the friendly PCs. The next policy, and I know we're coming up to time, so we're going to go really quickly with this. I want to be respectful, is a business management policy. So this is a policy that is like the malpractice, but for your C-suite. It's for your employees, for people that are making your financial decisions. It's to cover business crimes. And so it does not meant for a professional for malpractice and seeing patients, but it is the professional policy for the leadership of the dental office. Now, there's a directors and officers policy. This protects the owners and the executives and the employees from lawsuits based on their business decision. If you are 100% common ownership and you do not have any outside investors, partners, or board, you probably don't need this coverage because you're not going to sue yourself. If you have the 51%, you definitely need coverage because there's multiple owners that could potentially get mad at each other and bring lawsuit. And if you are taking any private equity or venture capital, you absolutely need to have this coverage. Most private equity require you to have the directors and officers at the board level, if not at every level. There's a lot of combination policies, but you do want to make sure that you have this in place if you're taking on any type of private equity, venture capital, or if you have any multiple ownership arrangements besides, a whole 100%, and there's not already an agreement in place. Employment practices liability is for any type of employee issues. So wrongful hiring, wrongful firing, harassment, hostile work environment. Like the amount of claims we see is just crazy. And the thing about it is that it doesn't matter if you think that you did it or not. A lot of the times, what the real cost is the defense to prove that you didn't, especially in certain states. Massachusetts is really hard. Colorado's really hard. New York's really hard. They tend to automatically fault with the employee, and then you have to really aggressively pursue the claims the other way. So if you have any employees, you should have an employment practices policy. You need to have this in place. And when professional service arrangements, DSOs and DPOs and group practices really need to have this in place, especially if HR is at a different level, because the employees tend to think that it is one, deeper pockets, two, there's not consistency between all the different entities. What the office level might allow people to do compared to what they were allowed to do before they were bought out. That's where you see a lot of inconsistencies with leave and wages and losses and just a lot of potential lawsuits. So that's a policy you really need to have in place. And then you want to have a crime policy because unfortunately, in this day and age, what we see is that employees embezzle, and oftentimes it's because there's not a lot of controls. It's employee theft, fraud, embezzlement. We've seen front office staff cash checks, take cash. We've seen them send out invoices or make charges on to their credit card. I mean, we've just seen it all. So everybody needs to have a crime policy. Sometimes you can get it as part of your office package, but once you get to at least 10 employees, you should have a standalone set of limits. At least 250,000 to half million is what you're going to need. So, and that's my spiel, but we just wanted to kind of brag again on us. We are, we're a member, Dentist Insurance Services is a member of AADGP, ADOM, DEO, Women in DSO. We are very happy to be a partner of Savardent. And we've done this for since 1989, and I've done this for 21 years, and this is what we do all the time. So it's what we want to do and what we're happy to be doing. We are really well known in the industry. We are the chairman brokerage for the Doctors Company. We're actually their sixth largest malpractice carrier nationally in all medical malpractice, and by far their number one dental. And that's on top of the Gallagher's and the other really large brokerage houses. We are number six above all of them, which is very impressive. We've been a president's brokerage with Liberty Mutual for the past 25 years. We are a Main Street America elite agency, which is only one of 26 nationally. So we are able to get underwriters to write policies the way we want to get the pricing where it needs to be. We get them to understand the risk because we understand it ourselves. We see the claims. We know what is risky, what's not. We know how to structure things, and that's what we're here for. So I'm going to leave you with my slide and say thank you so much for attending, and we really appreciate you.